action.
Dah.
Alamak, ni aku dah kena.
Ya betul. Tak apa. Nanti aku edit.
Assalamualaikum warahmatullahi wabarakatuh dan salam sejahtera. Before we start with our presentation, let me introduce myself and my team members. My name is Muhammad Abra bin Othman, and here is my team members: Muhammad Daniel Fikri bin Muhammad Nahar, Ahmad Majid bin Matlawi, and also Nur Nadia binti Zainab. Today, we would like to present the topic on the financial plan, which is subtopic on business plan. So, what is financial plan? Financial plan is comprehensive picture of your current finance, your financial goals, and any strategy you set to achieve this goal. This include the amount of funds and where they are coming into the organization, where funds are going and how cash is available. The project financial position to the firm. This plan is provide an estimate of the potential of the venture. Of course, any estimate is based on the set of assumptions regarding sale revenues and costs. Using the best available information and their intuition, entrepreneurs calculate the potential probability of the venture. Before we develop pro forma income statement, entrepreneurs need to develop a few things like operating and capital budget, sale budget, operating costs, capital budget, and forecasting budget. So, we continue with operating and capital budget. What is sale budget? This is estimation of sale revenue and the sale overhead for a particular period. A more accurate sales forecast means better utilization of resources, higher profitability, and less wastage. The sale budget is not a vague assumption of sales. However, it is well-planned strategy to streamline the various business operation and set some realistic and achievable target for the team. And also, this is preparing a sale budget is a step-by-step process. It involves keen observation, research, analysis, and decision making. Here's an example of sales budget.
Okay, my part is operating cost. What is operating cost? Operating cost is a daily expenses associated maintenance and administration business. It brings sales revenue and producing goods and services, as well as its overhead and other costs. For example, I can give you is like rental, machinery, payroll services, utilities, uniform, and office supplies. At last, he deducted from revenue to calculate operating income and also reflect by business income statement. Okay, for the capital budget. Capital budget is company process undertakes to define potential project and investment. It's also define expenditure that will give major impact to company in future. It means like this capital budget will affect the money flow for over than only 1 year. And last, company will analyze a project whether it hit sales target or not. That one is a capital budget's explanation. Here I show you the example of operating budget.
Now we go to other subtopic which we call as a forecasting sale. Forecasting sale means estimation of the type, quantity and quality of the future sale. Goal for the sale department is decide on the basis of this forecast, and this forecast also help in planning future development of the concern. The sale forecast form a basic for the production target. Sale forecast indicates as to how much of particular product is likely to be sold in a specific future period in a specific market at a specified price. The management of the firm is required to prepare its forecast of share of the market that it can hope to capture over the period of forecasting. In the other words, sale forecast is an estimate of the sale potential of the firm in future. All plans are based on the sale forecast. Now we go to pro forma income statement. Pro forma income statement is a projected net profit calculated from projected revenue minus project costs and expenses. Sale by month is calculated first. Basic of the figure, marketing research, industry sale, trial experience, forecasting and financial data on similar startup. Projection of all operating expenses for each of the months during the first year should be made. Increasing selling expenses as sale increase should be taken into the account. Changes in expenses during the first year can necessitate month by month illustration. Increase in individual expenses need to be reflected in the first year pro forma income statement. Projection should be made for year 2 and 3 as well. Consider expenses that are likely to remain stable over time. Now we go to the example of pro forma income statement. Firstly, the statement show, first we need to show the estimate of the numbers of the gloves sold in the 2020. Use that total to calculate sale, which is the first line item in the income statement, which indicate of the 520,000 ringgit. And after that, secondly, project cost for the leather and other raw material, and also the hourly rate for the labor which need to pay. For the material is 170,000 and also the labor 250,000, which total cost of the cost of goods sold is 420,000 ringgit. From this statement we can see that the gross profit is 100,000. And for the third step, the statement estimate the overhead expenses, which including office salary, depreciation, insurance, home office lease, marketing and advertising, and also repair and maintenance, which total cost is 90,000 ringgit. And after we deduct from the gross profit, and we get the net income around 10,000 ringgit for this end of the year 2020. Now we continue to other subtopic which we call as a pro forma cash flow, which I continue for the previous pro forma income statement, which we got the net income. After this, I try to elaborate some. Pro forma cash flow is estimate amount of cash inflow and outflow expected in one or more future period. Projected cash available calculated from project cash accumulation minus project cash disbursement. If excess cash is projected by pro forma document, this information can also be used to plan the most appropriate investment strategy for the cash. It is not the same as profit. Sales may not be regarded as cash. Use of profit as a measure of success may be deceiving if there is significant negative cash flow. Cash flow can be projected using the indirect or direct method. Okay, in the other word, the cash flow statement or statement of cash flow summarize a company inflow and outflow of cash, meaning where the business money came from, cash received, or where it went, or when the cash was paid. By cash we mean both physical currency and money. In a checking account, the cash flow statement is a standard financial statement used along with the balance sheet and income statement. The statement usually break down the cash flow into three categories. We can call it as operating, investing, and also financing activities. Okay, based on the example of the statement, cash flow statement, which we can see now, it started up with the net income which we can get from the previous chapter, 4,340, and also the attribute for the operating activities which we call as a we can see as depreciation, gain of sale, account receivable, and those attribute will sum or minus, and also will get the net cash flow operating activities 9,500, and will be add on for the net income. We'll get the total 30,840, and we go to the other sub column which we call as investing activities, which proceed of sale of land, inflow 40,800, cost of new plant assets we need to contribute around 40,000, and we got minus 25,200 for the net cash flow. For the financing activity, payment of notes payable which we need to outflow the cash 10,000, issuing the common stock 45,000 inflow, and also the payment of dividend outflow 440, which we need we got the financing activity net cash flow 34,560, and total of the cash flow around 23,200 for this end year, after add on the previous year 2017 years by 24,300, and we got the total balance of the cash flow cash balance for December 31st 2018 by 47,500.
Assalamualaikum warahmatullahi wabarakatuh. I'm going to continue the presentations. Next is pro forma balance sheets. Pro forma balance sheet is a tabulation of future projections and help your business manage your assets now for better results in the future. It can ensure that there are no surprises in the future when it comes to pay your bills, getting return on investor, and keeping your inventory in stock. Pro forma balance sheets consist of assets, items that are owned or available to be used in the venture operations. It can be current assets or fixed assets. Second is liability. Liability is money that is owed to creditors. It can be long-term debt or short-term debts. Last is owner equity. Owner equity is amount that owner has invested or retained from their venture operations. Is pro forma sources and applications of funds. Sources consist of operations, new investment, long-term borrowing, sales of assets. Meanwhile, uses or applications consist of increased assets, retire long-term liability, reduce owner or stockholder equity, and pay dividend. Last but not least is break-even analysis. Break-even analysis entails calculating and examining the margin of safety for an entity based on the revenues collected and associated costs. The break-even formula is divide the total fixed cost of production by the price per individual unit less the variable cost of productions. The analysis show how many sales it takes to pay for the cost of doing business. Analyzing different price levels relating to various levels of demand, the break-even analysis determines what level of sales are necessary to cover the company's total fixed cost. A demand side analysis would give a seller significant insight into selling capabilities.